fundamentals of our company are very strong. Our balance sheet is healthy and assets robust. Our EBITDA levels and cash flows have been very strong, and we have an impeccable track record of fulfilling our debt obligations. We will continue to focus on a long-term value creation and growth.
Hello and welcome. You're with us here on Business Today. I'm Abha Bakaya. Here are the headlines. The Adani headache grows as flagship company scraps its 20,000 crore FPO, says it will return the funds to investors. Reports say market regulator SEBI is probing the crash in shares. The Reserve Bank asks Indian lenders to produce details of their exposure to Adani Group companies. Gautam Adani's thoughts to energy business empire, which counts the state-run Life Insurance Corporation of India and the State Bank of India among key investors, has lost more than $100 billion in value since the Hindenburg charges made last week. Market continues seesaw trade even amid strong global cues. Sensex closed the session 224 points higher. Nifty closed the day off the day's low to settle above 17,600. The last full-fledged budget before the general elections, Finance Minister Sitaraman said the Indian economy is on track and headed towards a bright future. The first budget in the Amrit Kal, in a boost to taxpayers, major changes in tax slabs under the new tax regimes, and big railway and capex-centric boosts announced. Starting with the big story of the day, the Adani Group stock saw a second day of steep losses on the back of a slew of developments. The flagship company announced the cancellation of their 20,000 crores FPO, citing moral grounds. The big question now is how will the cancellation of the FPO impact the airport, road and green hydrogen plans of the company?
After a fully subscribed FPO, yesterday's decision of its withdrawal would have surprised many. But considering the volatility of the market seen yesterday, our board strongly felt that it would not have been morally correct to proceed with the FPO.
Adani Group chairman's video statement hours after justifying the stunning withdrawal of Adani Enterprises FPO, putting paid to the group's ambitious plans to trim some of its mountainous debt and expand its operations. Adani Enterprises had planned to deploy 3,335 crore rupees immediately in the last 2 months of current fiscal and a total of 7,535 crore rupees over the next 14 months. As per the company's disclosure, 4,165 crore rupees was to be used for repayment of loans. 10,869 crore rupees was to be deployed in several projects of the green hydrogen ecosystem. Improvement works of certain existing airport facilities like the Ahmedabad Airport project and construction of Greenfield Expressway under its road and highway subsidiary. The FPO money was to come in two parts. Half of the money at the time of the application and later on calls spread over 2 years.
अदानी एंटरप्राइज का ये एफपीओ बहुत ही सही समय पर आया है और हमारी 10 वर्षीय कैपिटल प्लानिंग का ये हिस्सा है जो कंपनी के फुल्ली फंडेड और डी रिस्क ग्रोथ प्लान के अनुरूप है. This decision will not have any impact on our existing operations as well as our future plans. We will continue to focus on timely executions and delivery of projects.
Adani Enterprises acts like a holding company for the group and has incubated new businesses in capital-guzzling infrastructure sectors. The company had actually planned to use the FPO funds for new sunrise businesses. Despite assurances by the group chairman, the bloodbath in the stock market is expected to hit Adani Enterprises hard. The current stock market sentiment towards Adani Group will now force the Ahmedabad headquartered group to raise high-cost debt or scale back its ambitious expansion plans. With its share price dropping nearly 45% in the past 1 week, the company's power to raise loans against equity has also declined. The Hindenburg report has also international lenders to handle Adani Group bonds with kid gloves, with reports that at least 2 global giants have stopped accepting them as collateral for margin lending. The group may, as a result, be forced to raise funds at a higher rate than it traditionally has. The one big upside, though, is the group's commitment to green energy, for which the government has ensured easy funding. Bureau Report, Business Today TV.
LIC could soon be facing losses in its investments in Adani Group companies. The mega insurer has already lost nearly 28,000 crores in profits it had made in the past few months. Meanwhile, shares of the group continued their slide today, even as reports have emerged of regulators SEBI and RBI holding a lens over the group.
Till 2 days ago, he was the richest man in Asia. Today, he is the man who has lost nearly half his wealth in the past 1 month. The bad times continue for Gautam Adani, with his companies losing $100 billion in market capitalization since being hit by the Hindenburg. The group has lost nearly half its market cap in 6 trading sessions. Adani Enterprises has lost 55% of its value. The worst affected counter, Adani Total Gas, is down 56%. 7 of the 10 Adani Group companies hit the lower circuit in trade today. Ambuja Cements was the only share which closed in the green. The plunge in the stocks continues despite the stunning decision by the group to withdraw the Adani Enterprises FPO last night. A lot of the selling pressure was due to reports that SEBI and RBI have started probes into Adani affairs as well, as Citigroup joining Credit Suisse is stopping use of Adani bonds as collateral for loan margins.
The fundamentals of our company are very strong. Our balance sheet is healthy and assets robust. Our EBITDA levels and cash flows have been very strong, and we have an impeccable track record of fulfilling our debt obligations. We will continue to focus on a long-term value creation, and growth will be managed by our internal accruals. Once the market stabilizes, we will review our capital market strategy.
One of the worst sufferers in this entire saga is LIC. The insurer has an investment of 24,000 crore rupees in 4 Adani Group companies: Enterprises, Total Gas, Green Energy and Transmission. This investment has grown to 33,000 crore at its peak. Today, the value was being pegged at 29,000 crore, with gains having fallen to around 5,000 crore rupees. The issue is already turning into a political hot potato, with opposition parties questioning the government in Parliament about investment by state-owned companies like LIC, SBI and SBI Life in the Adani Group. Bureau Report, Business Today Television.
Staying with Adani, the company's market losses have now swelled to more than $100 billion, sparking worries about a potential systemic impact. This comes a day after the flagship company announced the scrapping of the 20,000 crore follow-on public offer. The Adani stocks witnessed a second day of bloodbath following the announcement late last night. We at Business Today took it upon ourselves to put the declines into perspective with experts. Here's an excerpt from a conversation we had earlier today.
Does this mean that the hopes for a certain kind of earning and return from the markets has gone for the near term?
No, I don't think so. Number one, our markets were trading at a premium valuation. We were looking very, very expensive vis-a-vis other peer group. before the budget. And those valuations will continue to act as a brake on our short-term performance. But this budget reassures investors on the path of fiscal prudence. It creates growth multiplier through infrastructure investment and consumption boost through tax cuts. So our long-term growth story is not adversely impacted by any event, and investors will continue to look positively towards India, albeit not necessarily at current prices and current valuation. But I certainly believe every correction will be lapped up by investors to build exposure to India. We have also seen fair amount of selling by foreigners, as India was the only market where they were in profit, which was expensive, and where exit was available. Their holdings have declined from 20% plus to 20% minus. It's nearly at probably what was the bottom in last 10 odd years. So effectively there is not excess investment in India. The long-term growth story continues to be good, but you want to enter at a reasonable valuation, and hence this becomes a buy on dip market.
Okay.
What about Adani itself, Nilesh? I mean, how or what would you imagine? You know, because it doesn't take away from the larger plan, and I'll get in terms of the fact that they are going to need capital to complete their debt.
I mean, but what we have seen that for corporates to, they probably need three things in today's world: growth, governance, and some commitment. This combination of 3G, growth, governance, allowing you to tap institutional.
I just want to understand then that, you know, a lot of these group brokerage coverages, they've not been picked up by mutual funds. How is he going to do this, in the sense that tomorrow, even if you're and you come up with other offerings across group companies that you're going to see, and there's no clear visibility on that as we look for this to kind of resolve?
No, raising is difficult for Gautam Adani right now, because internationally the door every day with Citigroup and Credit Suisse and all of that, and if two are doing it, two more will do it, and in the near term, raising money in the Indian market, I think it will be a brave banker who sanctions Adani loan at this point in time with the way the news flow is. So where does he raise the capital from? But now the thing is a question of liquidity. You can stall expansion projects at this point in time, but I think if there is a liquidity constraint which comes in, then it's going to be a tricky one. And I actually don't buy this argument about him having assets which can be liquidated at any point, because liquidating an asset overnight is not that easy to raise liquidity capital.
Right.
He does have assets, but the question of assets also takes me back a few years to the Anil Ambani episode, because I'm not suggesting for a moment that this is an Anil Ambani situation at this point. It could well turn out to be, but at this point we cannot say that. But when this Anil Ambani unwinding began, people said, what is everybody worrying about? You know, this guy has power plants, he has infrastructure projects, Reliance Infra, roads,
Communication.
roads, communication projects, metro rail, and he has a full-fledged flourishing mutual fund empire. So what are you panicking about? And we know how that story ended. So, you know, all these assets, basically my contention is that people in the stock market actually know very little or do very little research about the quality of the assets. Remember Satyam Computers? The best and the bluest breed analysts would go there every quarter after quarter, and he would draw something on a piece of paper, all figment of imagination, and feed it to them.
And the audit reports then as well.
Audit reports as well, and nobody raised a question for years about what he was doing, and was cooking his books all his while. So what sanctity does all this talk about us sitting in our offices and commenting on what Adani Ports has on the ground and what Adani Power has on the ground? We don't know much about this asset.
Let me ask a broader question to Nilesh, because he's not here in his capacity for Adani. Nilesh, thanks for being a sport and taking these questions, because this was not anticipated. But I'm coming to a broader question and then afterwards to Saurav immediately after Nilesh. Would it be a fair question to ask Nilesh Shah at this stage that post the Adani incident, wherever there is large external debt of Indian companies, the risk premium will shoot up sharply? I'm taking this point beyond the immediate group, and whether there are broader concerns that you feel are likely to emerge.
So again, I don't think so that is likely to happen. For decades, India has received a far tighter spread compared to what its credit rating suggested. Number two, while Adani bonds are getting impacted, other Indian bonds are still trading at where they were trading before. Number three, as US interest rates have gone up and forwards have come down, the cost of borrowing in rupee market is now cheaper than cost of borrowing in global market on a fully hedged basis. There are few institutions like Exim Bank which has borrowed money in global market in recent times, but by and large companies are finding that rupee market is cheaper service global market. And to the Udayan point, when Satyam Saga opened, I was working in ICICI Prudential Mutual Fund, and you can check our portfolios. We had zero holding in Satyam Computer Services Limited. We had asked this question to Satyam management then, you show so much cash on the balance sheet, but where is the return? So it's not that mutual fund guys don't do the research. They do research. Sometimes we are right, sometimes we are wrong.
Equity benchmarks end the day on a mixed note despite robust global cues. The Nifty closed the session off the day's low, mildly in the red to settle above 17,600. The Sensex, however, closed the day higher, up 220 points above that 59,000 mark. All in all, it was another day of choppy trade. The day, however, did belong to the broader markets today. The mid and small caps closed the day in the green in an otherwise weak market, and stocks that made the headlines, well, Adani Group stocks. Street continuing to punish the group. A second day of carnage, both Adani Enterprises and Ports closing with cuts. 27% on Adani Enterprises and 7% on Adani Ports, while the other group companies were down about 10%. Names like UPL, HDFC Life and Eicher Motors all closed with losses today. The FMCG pack outshone other sectors. Britannia, ITC and HUL among the top gainers on the Nifty today. IndusInd Bank and Infosys were among the other gainers. Shifting focus to another big cue that we are tracking, a fine balance act. That's what experts are calling this year's budget. A blueprint for Amrit Kal. The budget, however, has raised some important questions as well. Why have crypto assets been excluded from budgetary consideration, given concerns about growth and indirect taxes? BTTV's managing editor Siddharth Zarabi and special correspondent Karishma Sadani had a chance to speak with the budget makers and key people. Take a look.
What really has been the thrust of the indirect taxation proposals of this budget?
Thank you so much. I think the major thrust, I'll talk about customs duties first,
Yes.
has been on simplification. And this is a theme which we've been addressing for the last couple of budgets. The idea there is twofold. In this budget, one of the major changes that I would like to talk about and highlight is the reduction in the number of rates. As you're aware, it has received sort of wisdom now that the more the number of rates, the more the chances of disputes and, complications. So we've been able to achieve a very big reduction, which is from 21 rates. We've been able to bring down the rates of basic customs duty to 13. That, in my view, is quite a big change, which will definitely lead to simplification of the rate structure. The linked issue is of review of exemptions. And if you recall, the finance minister had announced last year that all customs duty exemptions will be reviewed every 2 years, and those which have been there on the book for a long time will also be reviewed. So we've done once again a very major review of customs duty exemptions from the point of view of simplifying the rate structure.
How certain are you, sir, about the nominal growth number that's been pegged in at 10.5%? And if you could sort of expand on your own expectations with regard to the GDP number that you are working with?
Yeah. So I think the figure of 10.5 is a reasonable and, if anything, slightly conservative estimate of nominal growth. I say this for a variety of reasons. Firstly, I think whether it's the International Monetary Fund or the Economic Survey, real economic growth is expected to be above 6% next year. 6.5 in the Economic Survey, 6.1 according to the IMF, certainly in the range of 6 to 7%. So then for us, the nominal growth is what matters. It's a question of real plus inflation. If you take a combination of 6% real and 4.5% inflation, you're at 10.5. If you take 6.5% real and 4% inflation, you're at 10.5. So my long, exposure to the Indian economy, I have not found India to be a country where sub 4.5% growth happens very often or over a sustained period of time. So unless we have extremely low inflation, I think we will reach 10.5% nominal growth. And I think the real growth is quite robust to remain in the range of 6%. So I think 6 plus 4.5, 6.5 plus 4 are the ranges within which I think it's most likely to evolve. And I'm therefore and we have taken a very conservative buoyancy assumption of 1 in our revenue estimates. So there are several variables there. If you take the combination of them, I'm pretty confident that we will be within our 10.5% revenue growth estimates.
After almost 3 decades of attempts at disinvestment, we need to view it differently. You also spoke about how dividend receipts were part of disinvestment. Explain the broader philosophy and not just the number that's been pegged at 61,000 crore.
See, the DIPAM deals with 3 major issues. The disinvestment, which is generally being talked about. The second important thing is dividend, which also means that we have large CPSCs, large sector, which is commercial, which is productive, and which generates profits. And when we get the dividend, it is called government savings. You are, government is in control, and you get the saving. Of course, money also goes, dividend also goes to the minority shareholders in listed companies. And third important thing is the capex of the CPSCs. Now this 10 lakh crores which is talked about, this is only a government capex. We have not yet counted another about 4 lakh crore of capex which will emanate from CPSCs through their internal and extra budgetary resources. And that's a very important way of, again, bringing that kind of, whole lot of other advantages of capex also into the system. So therefore, I think what's important is to have a holistic strategy and not really looking at only one single line number, only to fill the budget.
We know that DA has been involved in preparing a consultation paper that has to be submitted, and it's a global effort. You've reiterated in the past. You're also leading the G20 finance track, which is discussing this. What is India's stance on it?
So as you recall that we had prepared a bill, went through internal discussions. Thereafter, there was a consensus that we have to deal with that at the global level. So we have reached out to IMF, and IMF is working out a paper in consultation with us to bring in the aspects of the monetary policy, bringing the macroeconomic aspects and the policy approach to crypto assets. And we had a round of meeting here on 15th and 16th of January in Delhi, where people from the developing economies were here, and we sat down with them and with the IMF. And now on the sidelines of the ministers' meeting of G20 in Bangalore, later part of this month, there's going to be a 135-minute seminar on crypto assets, on the policy response. And for that, again, IMF is preparing finalizing their paper that will form the base. And then we take it up. It is being held in other forums as well. For example, Financial Stability Board, it has proposed forming a crypto assets working group, and we are equally we are very much part of that. So the global efforts are on to build a consensus around the policy response.
So major countries, including India, are going to be a part of this?
That's correct. So the idea is that first the G20 countries arrive at a consensus, and thereafter that consensus has to evolve over all countries put together, because this being an asset class which can be traded across the boundaries on the electronic means itself, on the digital means, it requires all countries to be on the policy.
Right.
That's all from us tonight. Thanks so much for watching.